Hey everybody, this is Jim Duffy with MortgageLenderAtlanta.com. Going to talk today about some quick mortgage rate facts. We've seen that mortgage rates are at historic lows. A lot of people are wondering how long that's going to last, and a lot of people are wondering what to do. I talk with a lot of mortgage clients about the right loan for them. If you're going to be in a home long term, definitely the right loan for you is a fixed rate loan, 15-year fixed or 30-year fixed, even though a 5/1 ARM is extremely attractive right now. 5 years from now, it won't be attractive anymore. And I'm going to go through why that is. Rates have never been this low. We know that they're artificially and historically low, artificially being the key. Rates, generally speaking, go step in step with gold prices and with inflation. As inflation goes up, gold prices go up, and mortgage rates go up because bonds go up. Bonds, mortgage-backed securities are traded on the bond market, and they determine what long-term rates are going to be. That's not the case right now. We know that it's way out of step. I mean, back in 2002, what was gold? $250 an ounce, give or take. And right now, it's at over 1,000 and still going up. But yet, mortgage rates are still extremely low and going down. They're in the fours right now. Gold has been an historical predictor of inflation, and inflation hasn't gone up either yet. I think it will. I think there's a lot of artificial forces, what I call synthetic forces, moving rates down. Rates are just artificially low. Inflation is artificially low, especially with the continued printing of money that kind of devalues the dollar and increases inflation, or at least it should. We've all heard that the government's printing money right now. We're worried about it, we're upset about it, whatever it may be. The fact is, it should be an indicator of coming inflation. More on that if on a different video. The rates are down this low because the Fed is synthetically forcing rates down. What they've done is they're buying mortgage-backed securities and they're buying treasuries. And mortgage-backed securities traded on the bond market, that's what determines what rates are. They bought them to the tune of $1.25 trillion. And they said initially they were going to continue buying through December 30th of this year. Well, recently they've come out and announced we're going to continue buying but slow down the purchase of mortgage-backed securities through the first or second quarter of 2010, which will keep rates relatively low, all things being equal. But gold is still screaming at us, saying rates should be higher, they should be on their way up. Let's take a look at the trend in bonds and therefore mortgage rates. We can see that back in 1962, there began an upward trend. 8 years here, then you had a little bit of a dip, 8 years here, then it went up even higher through about 1984. Rates began coming down. That's a 21-year period where rates were tending upward continually. Now we've just gone through a 23-year period, 5 and 8 and 10, where rates were, tending downward. Up until about 2006. Look what happened there. In '06, we started another upward trend, and we should be continuing on that path, except for the fact that what took place is what I like to call that synthetic behavior. The Feds worked their magic and forced rates down when the market was screaming for rates to trend upward. And they've also forced inflation down. I mean, the Fed can't directly affect inflation by any means, but they can do things to sort of, for a time, tend to keep inflation at bay. And that's what they've done. I mean, we're in a deflationary period right now when the trend had been, since about 2006, inflationary. Not huge inflation, not anything scary, double-digit inflation, but it should be 3-4% right now. Instead, we're deflating by about 2%. What's going to happen? I believe that rates will be stable. I think we're seeing our last bit of rates in the fours would be my prediction. 30-year fixed rates still in the fours. I think if you can grab that, grab it now. But I think rates will be stable through the first, second quarter of next year. And stable meaning 5.5 probably. Again, barring anything completely unforeseen, catastrophes on a major level, et cetera, et cetera. I think rates will be good. And then I think it'll catch up with itself very, very quickly, and I think we'll see rates go to somewhere between 7 and 8%. I mean, again, nothing extraordinary, but they'll catch up to this trend line where they were and where it should be tracking right now. That's why I say if you're going to lock in a rate and be in a home for an extended period of time, what you want right now is a 30-year fixed or a 15-year fixed rate, depending on your budget and your goals. But definitely a fixed rate if you're going to be there for a while. So that's it. My name's Jim Duffy, mortgagelenderatlanta.com. Look forward to seeing you.